Good afternoon, everyone. Once again, thank you for joining us today. I'll be leading the discussion today on the recent amendments that have been carried out to the SEBI LODR regulations. In so there have been a lot of changes that have happened in the way in which disclosures have to be made by listed entities, and there's a lot to prepare for because most of the changes come into effect from the 14th of July 23. And with a short period of time that remains, it is always, helpful for listed entities to get more insights into those subjects. And today we are going to discuss in detail on the amendments that have been carried out, as well as the actionables that would be necessary for the listed entities to prepare for the incumbent change. Before we dive into the webinar, a brief about the broad spectrum of the services that we offer. I am Dipam Patel and I am a partner with Kantilal Patel and Company. Kantilal Patel and Company is a full-fledged professional services firm. Amongst various services, we have audit and assurance, that's one vertical, GRC, that's governance, risk and compliance services, taxation, again, within which we have direct, indirect, and international, as well as advisory services. We'll directly dive into the discussion. We are going to start with the background on how these changes came into being. We'll have the look around the applicability because that's very important, before diving into what are the changes. The first thing we have to see is whether they apply to the listed entity in question or not. And the third is we'll definitely look at all the amendments and that amendments we look in detail. So the first thing is about the background. The LODR regulations basically provide for the listing obligations and disclosure requirements for listed entities. So that is how the LODR is the governing framework for the listed entities in relation to their obligations vis-a-vis listing and their disclosure requirements. The amendments within the amendments that are the subject matter of discussion today are carried out by the SEBI LODR Second Amendment Regulations of 2023. They have been issued in June 2023. Now, the background to it is that since November 22, SEBI was rolling out various consultation papers. And once those consultation papers were kind of up for public comments, in the board meeting of March 23, SEBI had already approved these changes. And it was only a matter of time by which these would take the shape of the Gazette document and that it would be implemented. So the documents, the changes were issued on the 14th of the June. So 14th of June was the date when these changes were issued. And 15th June, they've got published in the Gazette. Now, the applicability as defined in the Second Amendment regulations is 30 days from the date of publication. So here it's very important to note that the issue date was 14th June and the publication date was 15th June. So 30 days from the date of publication would turn out to be 14 July 2023. And that's the date when most of the provisions come into effect. There are certain clarificatory provisions that come into effect from the 15th of June. But other than that, most of the provisions that we are going to discuss today would come into effect from 14th July. The first thing that we need to note is that the first section of the amendments that we have structured it in two phases, one which relates to corporate governance and one which relates to various disclosures. So the corporate governance provisions from regulation 17 to 27 and certain other provisions that are defined, they apply to listed entities only having paid up capital more than 10 crore and net worth having more than 25. So if for FY 22-23 the listed entity does not meet both of these criteria, then they kind of do not have the corporate governance. So section 1 of our webinar would not be relevant to them. Other than that, it applies to all other entities, the Regulation 30 related amendment. Secondly, from regulations 15 to 27 relating to corporate governance, they also do not apply to certain entities who have their non-convertible debt securities listed, which is with more than 500 crores. They are called HVLDs, which is high value debt listed entities. And those entities also have been given more relaxation on explain or comply basis. So it's like comply or explain. You need to either comply or you can explain why you have not complied with those. But largely, SEBI's intention is that even those entities have to be in compliance with the applicable regulations. So the theme of the webinar is, while we discuss the amendments, we'll also share the actionables for companies to prepare themselves with. So one of the actionable is relating to the checking of the threshold. So even for those entities who are on near the threshold applicability, the first thing they need to check is for FY 22-23, whether based on the audited financial statements, they get covered by the corporate governance provisions or not. The second thing is relating to a very, uh, you know, it's kind of an interesting interpretation by SEBI under the informal guidance scheme. In one case, in December 2022, for TCM Limited, SEBI has taken a stand that for the applicability of provisions relating to corporate governance. So this was under the SEBI LODR, where TCM Limited approached SEBI for getting clarification on how does the definition of net worth consider the revaluation reserves. For example, an entity has revalued some stuff and it sits in the revaluation reserve. Then for LODR, SEBI says that it should be included and that even if it is fair valuation under Ind AS, that should be taken into consideration. And the same set of question in context of where the entity had to meet a 100 crore net worth criteria for debt listing and debt issuance. In the case of Muthoot Healthcare in March, SEBI has taken the reverse view that these revaluation items will not be considered towards net worth. Interestingly, both these regulations define net worth to mean as per the Companies Act. So this is one anomaly that we just thought it would be interesting for the attendees to know. So there are certain amendments that are effective immediately. So we'll take those first because they're already effective as we speak. The key amendment that applies is in relation to sale, lease, or disposal of an undertaking outside scheme of arrangement. So if a listed entity goes to sell, lease, or dispose of an undertaking outside a scheme of arrangement, then they have to follow the requirements of getting a prior approval of shareholders by way of special resolution. Now, the definition of an undertaking or whole of the undertaking or substantially the whole of the undertaking is taken and given the same meaning as is within the context of Section 180 of the Companies Act. So the undertaking in terms of a company means the assets that form more than 20% of the net worth or generate more than 20% of the income. So the 20% criteria is relevant for these items to consider as an undertaking. Secondly, the substantially the whole of the undertaking again takes 20% as the threshold that within an undertaking, if the item or the part that is being sold is more than 20%, then that also will substantially be the whole of the undertaking. And either of these transactions would now require a prior approval of the shareholders by way of a special resolution. It would be interesting to note how this comes into play because here they have also given two more requirements. So in addition to there being an explanatory notice required to be attached with the notice for the meeting, they have also asked the disclosure for object and commercial rationale plus the use of proceeds. So this all is procedural and can be taken care of. The second requirement is very interesting. It requires the positive vote of public shareholders. So there are within public shareholders also, they have carved out an interested public shareholder. So what would happen is that when the entity, the listed entity would put this resolution to vote, the listed entity would first have to carve out within the public shareholders. So earlier they were just promoters and so related parties and public shareholders. Now they would go for even within public shareholders, whether any public shareholder is interested in this transaction, if he is the buyer or the beneficiary of this, which is sale, lease, or disposal. So if he is the other party on this for the undertaking, and within the public shareholders also, such interested parties would have to be carved out, and those parties would not be allowed to vote on the resolution. So if you look at the language in the LODR, at other places it is that the related parties cannot vote to approve. Here they have simply mentioned vote. So even they can't vote to approve, or they cannot even vote to disapprove the transaction. So that's an interesting carve out here. Largely, they've also given an exemption when a listed entity moves or does a SLD, which is a sale, lease, or disposal of their undertaking or substantially the whole of their undertaking with a fully owned subsidiary. The books of account or the financial statements of which are merged with the listed entity, then that SLD will not be subject to this requirement. However, the moment when the wholly owned subsidiary ceases to be a wholly owned subsidiary by way of dilution, or if the wholly owned subsidiary further sells this undertaking, then before that selling, the same requirement would get kicked in, and the resolution for this transfer SLD would have to be put to vote for public shareholder approval. Again, if the so in the entire context of the amendments that have been carried out to the LODR, one thing is common, that wherever they require shareholder approval, the two things where they don't require a shareholder approval is if whatever thing that requires the shareholder approval is carried out by virtue of a covenant under an agreement with a financial institution registered with the RBI, and that is a breach of that covenant, and basis that breach, that agreement kicks in to take control or to have a transfer or SLD or whatever, or the same thing in relation to a debenture trustee registered with the board. So if the listed entity has issued debentures and they have a debenture trust and a trustee, and when they have a relationship where if pursuant to that trust deed and the agreement between the listed entity and that trust, if the debenture trustee takes control, then either of any provision where there is a shareholder approval required, that all gets superseded, and that would kick in automatically, and there would not be a requirement of taking any shareholder approval. So that is just a common thing where it applies across all the provisions. So whenever it comes next, I'll just refer to financial institutions and debenture trust. The other amendments that come into effect immediately are HVDL, which is high value debt listed entity. So they have been given a comply or explain basis exemption up to 31st March. The second amendment that comes into play immediately is the BRSR core. So SEBI has already in March notified how BRSR core will apply, and it will apply from FY 22-23. That also has, FY 23-24. So the current financial year. So BRSR core and its related measurable KPIs. These things will apply from the financial year in which we are currently. And for that, they have already notified it. BRSR core largely has measurable KPIs as performance indicators of the entity in terms of how their efforts in ESG front are getting reflected in measurable terms. So that's more like a measurable reporting. And for those entities which have listed or issued non-convertible securities, which are in the nature of debt securities, these entities which had to intimate the confirmation of payment of either dividend, interest, or repayment or redemption of principal. So these entities were required to report this to the stock exchange, And it was very similar, just that they have notified a prescribed format in which this intimation going forward has to happen. So these were the first section of the amendments. First, the actionable we have to understand is whether it applies to undertaking moved to WAS earlier. So the first thing is whether, if before this amendment kicks in. So for this case, what has happened is that the SLD of an undertaking to a WAS requires now prior approval of shareholder before WAS ceases to be a WAS or WAS further SLDs the undertaking. So whether the first question is that if today there is an undertaking which has already been either sold or disposed of to a WAS, and then now if in the future the WAS does the SLD further, would it require shareholders approval or not? In my view, so far as the legislation was not in place, it should not apply, and it only applies to transfers that take place going forward from 14th June and not before that. Secondly, the secretarial team would have to enhance the vigilance on transactions, because 20% threshold sometimes, within that undertaking definition, substantial part of undertaking. So 20 is just 4 or 5% of the total. So if substantially a part of the undertaking is also transferred, then the entire requirement of getting shareholder approval kicks in. And the third is that in the present year, BRSR 4 is applicable. So KPI, which is a measurable form of understanding the impact in these sustainability areas, that needs to be assessed for by the listed entities to check how their BRSR 4 reporting would look when it actually gets published for 23-24. The second set of amendments, before we go into the disclosure requirements, which is the Regulation 30 amendments, are those which come into effect from 14 July 2023. So one of these amendments is in relation to vacancies in office. Now, when we talk about vacancies in office, there are multiple amendments carried out, and they largely relate to two categories. So one is KMP and the other is directors. So when we talk about KMP, we are looking at compliance officers, chief executive officers, managers, CFOs. When we look at a vacancy in the office of these executives, the vacancy has to be filled at the earliest. The guidance is that it has to be at the earliest and in no case later than 3 months from the date of vacancy. So when a KMP leaves the organization or there is a vacancy, that has to be filled up within 3 months at the max. Secondly, they've also put up a condition that such appointment has to be made in accordance. So if there is an interim capacity, for example, if a compliance officer or a CS leaves, and if the listed entity chooses to say that the CFO would do the interim role or interim capacity of the compliance officer, then that needs to be reevaluated, because now the condition is that the obligation under such law as are applicable to such person are applicable to the interim person, as well as the appointment for such interim person is made in accordance with the laws applicable for fresh appointment, which means that if so regulation 6 of SEBI LODR requires a compliance officer to be a company secretary. So that there cannot be an interim position filled up for the compliance officer by the CFO unless and until the CFO is also a company secretary, or by any other person unless and until they satisfy the requirement, the legal requirement of them being a company secretary. So one, even if there is an interim vacancy filling, that can only happen if and only if the person who gets the appointment satisfies the condition, if that condition is for the fresh appointment. So compliance officer's vacancy can only be filled up by a person who satisfies the requirement of that being a company secretary. The second requirement under law is that that person should also be made applicable with all the roles, responsibilities, and obligations that come with that position. So interim position filling will now become a challenge and would increasingly be, it would be discouraged even by listed entities and the persons because the obligations are just significant. When we come to the vacancies for director, which is director, managing director, or full-time director, there is a slight difference. One difference is that uh, if during the tenure of the director, if a person uh, leads to a vacancy. For example, if a director dies or maybe resigns, either of that situation, the listed entity has been given a time period of 3 months to fill up the vacancy that arises. However, in the case where the vacancy is being caused on account of the expiration of the term. For example, if a director has been appointed for 5 years and if the vacancy is going to be caused on account of expiration of the term, that is at the end of 5 years, then that vacancy has to be filled up not later than the date on which such office is vacated, which means if a person's term is getting concluded on the date of the AGM, and if that conclusion of the term, that is the expiration of the term, results into either the number of directors falling below six, or the woman director condition not being met, or the independent director condition of for one third not being met, then in that situation, that requirement would have immediate implication, which means that if the vacancy is on account of expiration, that last day they have to replace the position. They can't, the listed entity can't get a period of 3 months. Also, they've given a proviso that if on account of such expiration, none of those women director condition or the independent director ratio on the board or the total number of directors falling below six, if none of them get violated, then the listed company does not necessarily have to fill up that vacancy. So that leeway is given. But other than that, this provision applies. One more interesting change is in relation to permanent directors. Now, if the articles of a company provide for a permanency of a board seat, then SEBI LODR requires that these persons who have a permanent board seat need to get approval of the shareholders once in every 5 years. And even for those permanent directors who are there on the board of these companies and have not been voted for in the position in the last 5 years from the date of this notification coming into effect. So even though the LODR gets amended from 14th July 23 for this provision, the timeline for compliance is given for the first general meeting post 31st of March 24. So anyone who is a permanent director and has not been appointed to this position by way of a shareholder approval, that can still wait till the first general meeting after 31st March 24, but not later than. So existing also and thereafter also approval has to be held once in every 5 years. What is this not applicable for? So they don't want repetition. So if a person who has been already appointed as a WTD managing director, manager, independent director, or if the person has been appointed and is liable to retire by rotation, then for these categories, this provision does not apply because they are already getting appointed by shareholder approval separately. They're also not applicable for nominees of financial institutions or debenture trustee, as I mentioned earlier, and also not applicable for director appointed by a court or a tribunal order, or a nominee director of the government, or a nominee director of a financial sector regulator on the board of a listed entity. So these are the exceptions. Even if they are permanent in nature, they don't require shareholder approval for getting ratification of that appointment even after the transition date. So this is for permanent directors. Similarly, even if a listed entity's articles give special rights to any shareholder, then that special rights also now need to be given in terms of a shareholder approval, which has to be given once for every 5 years. And those special rights also, again, similarly, the effect The special rights that continue as on July 14, 23 need to be approved within 5 years from July 14, 23. So there are different timelines within which you need to get this compliance done. But again, it does not apply to financial institutions and debenture trustees. So I'm not discussing these provisions in much detail because they are rare. Though Reliance Industries Limited does have a permanent board seat, they do have the appointment other than that for the directorship. And next amendment is in relation to cyber security incidents. So every listed company has to fill up a quarterly compliance report on corporate governance. So this applies to those listed entities to whom the provisions relating to corporate governance apply. Those listed companies have to file a quarterly compliance report with the SEBI. Now, the the provisions have been amended to provide for additional reporting in relation to cyber security incidents, including breaches or loss of data or documents. So they have defined cyber security incidents separate, means they have not defined, but they have mentioned cyber security incidents separately and breaches or loss of data or documents. So again, the secretarial team has to work very closely with the IT team to understand whether such events have happened during the quarter and whether those events can be said to be a cyber security incident or a breach or loss of data, and whether that event would require our reporting in corporate governance compliance report every quarter. Another amendment is for new listed entities. Sometimes listed entities that were newly getting on the mainframe, they were not putting the first quarter results and they were only putting it later on. So the LODR has been amended to mention whether after IPO, they need to put their first quarter report immediately or within 21 days from its listing, whichever is later. So they also don't have any blackout areas between the last reported financials in IPO and the next quarter reporting. Another amendment is for the investor meet that in addition to the disclosure requirements, even the website of the listed entity needs to carry the information of an investor meet at least 2 days clear before the meeting date, which means that if the meeting is on Thursday, then it has to be on the website of the listed entity by Monday. So they need 2 clear days before the date of the meet and after the date of the announcement, which means Monday and Thursday will not be counted. Only Tuesday and Wednesday would be counted. This is an example. So similarly, any 4 days has to be like a reverse calculation for the investor meet to get adequate disclosures in place. So that brings us to actionables for the section 2 of our webinar. One is composition of the board has to be checked and markers should be placed for board members. So if there are specific members, for example, most companies would have a woman director who would have a very key role on compliance with the applicability requirements of regulation 17.1. So they'll have to put markers on these people that if this person's term is expiring, then we need to get a reappointment or we need to get a replacement on the date of their expiration and it cannot wait. Similarly, one more question is relating to whether if the compliance report for Q1, because the compliance report additional requirement, which is in the form of one, that the cyber security incidents have to be reported for. If that report, because the amendment comes in on 14 July 23, and the time limit to file that report is up to 21 July. So whether the reports that are filed from 14 July till 21 July will they have to be in the new format or the old format. So rather than answering this question, it's better to file it before 14 July so that you're always in compliance that the old format works. If not, then whether if there has been a cyber security incident or not, you just add that disclosure requirement if you file the report after the 14th of July to be on the safer side. Largely, I believe that it should only apply from quarter 2. However, it's always better to have more compliance. It doesn't harm. Then the quarter two report has to include a cyber security incident monitoring and stuff. So largely the IT team should also be instructed to monitor and log them separately, because ultimately if you are certifying that this has not happened, then you should also have some basis to mention that this has not happened. So logging of these incidents should also be initiated so as to ensure that you are in compliance while we certify. The third thing is that the investor meet schedule starting 14 July needs to be checked, because the website needs to be updated at least 4 clear days of the meet. And that entire SOP should also be framed by the secretarial team so as to be in compliance with the revised LODR. And if there are any permanent directorship or special shareholder rights, then they should also be in the action plan for the next general meeting of the company. Now, before we take up the third section of our webinar, I would like to inform all of our participants that we have a Q&A section. So, as such, the attendees in the webinar are in a mute mode. Under Q&A, we have a couple of administrators who would be in a position to unmute you if you have questions. Largely, I would say that if you have questions right now, you can put it in the Q&A section and we can take them at the end. Yeah, so now I'll continue with the third section, which is the most, it's a wide section that covers a lot of information that now needs reporting. And we'll deep dive into this. And this is in relation to the disclosure of events or information. Regulation 30 of the SEBI LODR regulations has been one of those regulations which has a far and wide reaching impact for almost all listed entities. We also have discussions with our client as to whether, this is a Part B item and whether this can be considered material, or, how should we take into consideration whether this is a reportable event or a disclosed or an item requiring disclosure to the stock exchange. How do we address so even stock exchanges have been asking questions to listed entities that there are news reports in the mainstream media that need your attention. There's a significant movement in the stock prices. We need your answers to this question. So all of that, there have been a lot of to and fro between the stock exchanges and the listed entities, which would still continue, but a lot of it has been tried to be ironed out with this. It gives a little bit scientific approach to how you will discuss and decide on the disclosure requirements, but at the same time, it leaves open a Pandora's box as to whether so much of a disclosure was at the first point necessary, or whether it is really material for the listed entity. And that is where the first change is in relation to quantification of materiality. So on the slide on the left side, we have the existing provision, and that existing provision is largely of a qualitative nature, where it has been mentioned that the listed entity shall consider the following criteria for determination of materiality. And those criteria were related to whether the omission of an event or information is likely to result in discontinuity or alteration of event or information already available publicly. So largely qualitative. In the new provision or the amended provision, the earlier A, B, and C remain. So A becomes A, B becomes B, and C becomes D. And they've inserted a new provision which is C. And our focus today in the third section of the webinar is going to be on C. That has been the path laying stone for the entire road ahead. And what the regulator has tried to do here is to give a scientific approach on determining material events that require disclosure, and how an event or information is considered to be material is either so the value of that item or information or event, or the expected impact in terms of value. So either there's a fixed value. For example, you have a receipt of a contract and it has a fixed value. So those contracts with fixed value are something which would have in whose value, or you have a capex, which is a capital expenditure. And if the impact of that capital expenditure is going to result into any breach of these things, now they have not given a timeline as to whether the impact has to breach this threshold of one financial year, or means whether it has to be looked at. So, for example, if there's a capital expenditure of say 100 rupees, and it is going to result into a significant impact over the life of that capital asset, which may be that the 100 rupees would be in a position to give us a revenue of say 200 rupees. And that 200 rupees might breach the threshold of one financial year. But those 200 rupees would accrue over multiple financial years. Now, this is a gray area, but the wordings are expected impact in terms of value, and they have not defined or contained expected impact within a financial year. So, though the expected impact has to be quantified, it has to be matched with the variables of one financial year. The plain reading of it suggests that the expected value has to be over the life of that uh, expenditure or item, and the comparison has to be done with one financial year. So the comparison has to be done with the lower of the following items: one, which is 2% of turnover, or 2% of net worth, or 5% of the average of absolute value of profit or loss after tax. So it's turnover, net worth, PAT or LAT. And the PAT or LAT has to be put into absolute terms, which is if there's a profit of 10 crores, profit of 12 crores, and loss of 2 crores, then it would be 10 plus 12 plus 2, not minus 2, and divided by 3, which would be your benchmark. If the value or the expected value of the information or event is going to be more than lower of any of these things, then that needs to be reported to the stock exchange as a disclosable item. Plus, the reporting has to be done on the basis of the audited consolidated financial statements, which means it's at the enterprise level and not at the entity level. So the listed entity would have to disclose this provided it breaches the consolidated benchmarks basis the last audited financial statements. So this is one important change in the way in which materiality has to be determined. Plus, so this is like a path setting way. This is like the bottommost layer. If it breaches this, then this is always material. Plus, anything that does not breach this, but in the opinion of the board is of such importance that should be disclosed, then that continues to be applicable. So the qualitative parameters of evaluating an item continue to apply, but this becomes the base of determining whether an item or information or event is material or not for disclosure. So this applies to Part B items. Part A and Para A of Schedule 3 continues to apply without materiality limits. We'll discuss that also as we go forward. So the first amendment, as we discussed, that there is a change in the materiality threshold for the paragraph B items. Now so the regulator has also required disclosure of any event or information which continues on the date of coming of these regulations into effect. And that materiality, if the information or event that continues on the transition date, which is July 14, 2023, then they have to evaluate all such information. All the listed entities have to evaluate the existing information and events which are carrying on 14 July 23, and within 30 days make a consolidated disclosure or even separate disclosures, but all of these items have to be disclosed on the stock exchange. And this is kind of a very far-reaching impact, because at some time you might have done capital expenditure which might have crossed these thresholds, and now you are still getting the benefit out of it. And whether it breaches the threshold or not, it's very subjective. So at certain times you will have to take that call, and ideally the next step that needs to be done is to revise your policy for determination of materiality, because under the regulations every listed entity has to have the policy on determining materiality for regulation 30, and that policy has to be approved by the board of directors of the company. So unless you have a board meeting before 14th of July, that is largely not going to be possible. So it's more that you would take that as a matter taking approval within the first board meeting after the 14th of July. But that also becomes a part of your actionable. So under the policy requirements, a new guidance has been introduced in the LODR, which says that nobody or no listed entity can dilute any requirement specified under LODR. So even if you want to define a materiality policy which is say 5% of turnover and not 2% of turnover, that you cannot do. You can do a policy which is lower than this or this, but you cannot do anything which is less than this, which is you can't dilute the requirement specified under LODR. Plus, now it has also it has a far-reaching implication that the relevant employees have to feed the key employees. So KMPs have to be fed with information by relevant employees, and the relevant employees include senior management. Plus, they have also not gone on whether relevant employees are senior management only. So the policy on determining materiality would also have to address who the relevant employees are, how these relevant employees will communicate about matters of significance with the key managerial personnel for them to decide as to whether this item meets the materiality definition as per the policy, and whether this has to be made with the necessary disclosures. So this key change has to be made in the policy for determination of materiality. The timeline for disclosure. So now one part of regulation 30 was in relation to the matters that now are or have to be considered as material. So once you have determined whether an item is material or not in lines with the revised timeline, the revised guidelines of how to determine a matter as material or not. The second step is by when you have to disclose it. So the timeline of disclosure is if it emanates from a decision taken by the board of directors. So it's not just for financial statements or meetings where financial statements are there. But if any board meeting happens and if a decision or if any event or information is coming from a decision taken by the board of directors, then that has to be disclosed to the stock exchanges within 30 minutes. The second category, which was largely 24 hours, now has been moved into two buckets, which is if the event or information emanates from within the listed entity. So, for example, if there is a, a budget or a capital expenditure approved, which is not by the board but the senior management or whatever other way in which this has been approved, then that has to be provided to the stock exchange within 12 hours from the occurrence. So it can't wait till 24 hours. And if the event, which is material, is emanating from a source which is not from within the listed entity, then that can be disclosed to the stock exchange within 24 hours. In any of these cases, if the timeline is not met, which is that the disclosure happens slightly later than this, then the listed entity has to disclose the reason and provide the explanation for the delay. There is then another requirement, which is the disclosure of events or information, which is that now mainstream media monitoring will also be a part of the secretarial teams. The requirement that has been cast on listed entities is to issue a clarification, that is either to deny or to clarify. So if the listed entities deny any rumors in the mainstream media, they can simply deny that this is not the fact and we don't stand by it. So if you would look at the recent disclosure by Tata Consultancy Services, they will put that this is what is reported as a fraud is not actually a fraud, and that's not within the organization. It's something outside the organization, though it is a violation of the code of ethics of the organization. So that's kind of a clarification that they have, or denial that they have issued, and further clarified why they are denying it. Now, mainstream media confirmation needs to be there, which is either the listed entity has to deny the report, or if they do not deny, they have to clarify along with the current stage of the event or information. And this clarification has to be issued for each such rumor, which is not in general nature, which is not general in nature, or which indicates that rumors of an impending specific material event. So again, material has to be determined in basis of the earlier thresholds that we discussed as soon as reasonably possible. And again, the 24-hour timeline still applies for this disclosure to the stock exchange. Now, here, interestingly, it also is a cross with the unpublished price sensitive information, which is UPSI, where in May of 2023, the SEBI has again brought out a consultation paper wherein they are suggesting that UPSI definition should also be aligned with the information or events that are considered to be material. So if that comes into picture, then this is going to be a big effort maintaining the structured digital database for UPSI along with this and having all the timelines aligned for listed entities. Then one, sorry, I thought I skipped the slide. Let me go. Okay, yeah. So then comes a position where it is disclosure of events or information. One more requirement has been added, which is receipt of a communication from any regulatory, statutory, enforcement, or judicial authority. The listed entity has to disclose such communication along with the information or event. So till now, it was just some disclosure being made by the listed entity in the stock exchange. Now they have also to issue or attach the communication which has been received along with the disclosure, unless such disclosure is prohibited by such authority. So unless there is a prohibition, it doesn't. So the listed entity has to provide the communication of that, a copy of that communication even to the stock exchange. Now we come to the amendments to Schedule 3. So we'll just briefly revise or refresh what Schedule 3 relates to. So para A of Part A of Schedule 3, it is always deemed to be material and has to be disclosed as per the mentioned timeline. So if any event mentioned in para A of Part A of Schedule 3 happens, it's a deemed material event. And the second category, which is para B, which is kind of a litmus test. You have to test it for materialities. It's kind of a tested uh, tested material event. And the first para A is always a material event. So it's deemed material event and tested material event. So para B has to be as per the timelines in regulation 36, which is either 30 minutes or 12 hours or 24 hours. And para A, again, if there is a specific timeline mentioned there under in entire part A. So earlier it was only sub para 4 of para A, which had the specific timeline, and that was the requirement in regulation. Now the regulation says entire part A, provided that there is a timeline mentioned in there. If not, then it would be governed by the general timeline of 30 bracket 6, which is either of the 30 minutes, 12 hours, or 24 hours. Now, with this amendments to Schedule 3 Part A, so Part A is deemed material event. Now, what are the additions to deemed material events? So, acquisition, sale, or disposal of undertaking, or whole or substantial part. So if there is an acquisition, sale, or disposal of an undertaking or a part, substantial part of the undertaking, then that is a deemed material event and that requires the disclosure. Sale of stake in an associate company of a listed entity. So earlier, the sale of stake was only in relation to subsidiary. Now they've also extended it to an associate company. And what does a sale of stake mean? Is for a WAS to stop being a WAS, for a subsidiary to cease being a subsidiary, and for an associate to cease being an associate. So even if you sell 2% of your associate, but it goes down from being an associate to not being an associate, then that disclosure also has to happen. There has been now a broadened definition for acquiring control, which also includes events where cost of acquisition or the price at which the shares are acquired exceeds the threshold that we discussed, which is 2% of turnover, net worth, or 5% of average profits. So if any of this trigger also change is breached, then that would become a deemed material event. Earlier, it was only revised credit ratings that used to be reported as a material event. Now it is new reportings also. So whether renewals of reportings are to be reported or not, it's always safer to comply. If you have a renewal of reporting, you have to consider it to be a fresh reporting or a reporting, and that's how you would ideally disclose it to the stock exchange. Now, fraud and default, they have included definitions for it. Plus, earlier only fraud and default by directors were into directors and KMPs were in Section A or Part A. Now, they have also broadened it to senior management. So, if any of fraud or default happens by people up to the level of senior management, then that disclosure has to go to the stock exchange. Thankfully, default has been also given with a proviso or an explanation that a default, so for example, credit card defaults would not come if a KMP or a senior management has missed his credit card payment. Then ideally it doesn't come and get disclosed over here because default they have defined as any missed payment, which is either of interest or principal. But the explanation is that that missed payment or missed event should be having an impact on the listed entity. So far as that impact on the listed entity is not there, that disclosure requirement should not apply. Also, change in senior management now included as a compulsory disclosing item. So earlier only KMP change were as a compulsory disclosure. Now even senior management, that is one level below the board, that entire layer, if there is a change in that, that becomes a reportable event by a deemed material event. The carried amendments are, for example, if MD or a CEO who is not available or is indisposed for a period of 45 days in a rolling period of 90 days, then that has to be disclosed to the stock exchange with the reasons. Now, this is pure full unavailability, not work from home or kind of intermittently available. That 45-day period within 90 days has to be complete, unavailable, or indisposable. Now comes a very interesting amendment, which is in relation to social media posts by people up to the level of senior management. So, as a secretarial team, now you have to take, cognizance of social media handles of your senior management people up to the level of senior management, whether they are posting anything on social media which affects the business of the entity and whether that is a material intent or information as per the revised thresholds. If there is a post by such person, then the material, and if it is a material event or information requiring disclosure, then the listed entity also has to either do a clarification or post or publish it on the stock exchange and disclose it on the stock exchange, which is kind of going to be a nightmare to achieve. And you'll have to monitor each of those tweets. And if you forget to do it, and if there is something that comes up as material, then you're facing an unknown situation. And then you have to disclose it to the stock exchange along with the reason this not being there. Then compulsory disclosure of orders passed by any regulatory, statutory, enforcement authority or judicial body against the listed entity or its directors, KMP, senior management, promoter or subsidiary, if of the following nature, which is search, seizure, reopening of accounts or voluntary reopening of accounts for investigation. Again, various other compulsory disclosure of orders has been prescribed again to the same set of people. It is either in the nature of suspension, fine, penalty, settlement proceedings, debarment, disqualification, closure of operations, sanctions, warning, caution, any other similar action by whatever name fall. So late fees are not covered here. So largely most of the commonly missed compliances would not be coming here. It is largely in the nature of fine or penalty. It's not even interest. So if the GST return goes a bit late or maybe there's a delay in payment of some statutory due, that would not directly come over here. But yeah, if there is a fine or a penalty imposed on the listed entity, then that has to be disclosed over here. And again, this is part A, so there is no materiality threshold over here. So if this event happens, it goes to the stock exchange, irrespective of it being a small amount or a big amount. Then comes to the material events which have to be determined, which is amendments to Schedule 3, Part B. So loan agreements earlier, it were only in the position of a borrower, which are not in the normal course. Now, it was very rare for a listed entity to have a borrowing agreement, which is not in the normal course. So largely the intent also was on the lending side, that if a listed entity enters into a loan agreement on the lending side, then that should be disclosed considering the materiality thresholds. And that has been put into Part B item. Frauds or defaults by employees below senior management have been brought to Part B, which is something that would require applicability of materiality thresholds. Delay or default in payment of fines, penalties, dues, etc. to any regulatory set. If there is a delay or default in such payment, that also has to come up here. The another amendment is in relation to disclosure in annual report. There's one change that is we'll discuss clause 5A, which is in relation to shareholders agreements or agreements in relation to control activities. It's the next part. Before that, we also have to disclose any particulars of senior management. So all particulars of senior management, including their changes since the close of the previous financial year, have to be disclosed in the annual report. One more amendment has been prescribed, which is in relation to disclosure of agreements binding listed entities. So for example, if there is a transaction, between either shareholders, promoters, promoter group entities, RPs, directors, KMPs, and employees on one side, and any party on the other side, with relation to change in control or change in the shareholding of the listed entity or the holding company of the listed entity or subsidiary or associate, then the agreements have to be disclosed. So the key terms of the agreements have to be disclosed to the stock exchanges, and the responsibility has been cast on the party. So the time limit. So largely the regulator also understood that it was not going to be possible for listed entities to capture all this information, because some shareholder in some associate company may agree with the shareholders on this side, and there may be a transaction which the listed entity can't be aware of. So they have put a timeline for such parties. So if such parties don't report to the listed entity, it would first be their non-compliance. And then the listed entity has to report within 24 hours, because this is an event or information that does not emanate from the listed entity unless it is a party to the contract, in which case it would only get 12 hours to disclose this. So this is there, plus subsisting agreements have to be disclosed. So on 14th of July, you have to see if there are any such agreements of the past which require such disclosure. And if they have not been disclosed, they have to be disclosed. Plus, for this year, they also have to be disclosed in the annual report for all the past years. And going forward also, it has to be a part of the annual report. Now, with that, we come to the last part of our webinar, which is the actionables on Regulation 30, which is one of the most important part. An evaluation of all continuing events and information, because it has to be disclosed by 13th of August. So you have to evaluate on 14th of July what all events require disclosure to the stock exchange. You have to list them out, prepare, and you have to actually disclose them out under either of para B or any of the continuing provisions that we have discussed in this webinar. Amending the policy on materiality under Regulation 34 Clause 2, which is one. The first question comes, when do we amend? Before 14 July, because it requires a prior approval of the board of directors, and whether the secretarial team can amend it, implement it, and then take ratification of the board of directors. Largely in such cases, I have not seen any adjudication being carried out by SEBI. So it should be fine if we can get that in place by the first board meeting after the implementation date. But the implementation of those material policies has to come in before. The second, identifying relevant employees and incorporating those designations in the policy for materiality, because those people have to now be the feeders for KMPs to determine whether the item is material or not and requires disclosure or not. Plus, if any of the parties that are covered, either the promoters or any of the parties discussed earlier, who are subject to an agreement where that disclosure is required by the listed entity to the stock exchange, then that also needs to be there. So with that, we can open the Q&A. I'll just see if we have received any questions. Okay, I'm just checking. Okay, we have 3 questions. One of which is whether disclosure of every undertaking is required to be disclosed. Every means okay. So it would be either sale, lease, or disposal. So SLD of every undertaking. So undertaking or so it's basically the undertaking definition and the substantial part of the undertaking. So that definitions come from section 180. So those definitions have to come into picture. And if those thresholds are breached, then yes, every such transaction needs to be reported to the stock exchange. I think we addressed this, but I'll still take it. The agreements, whether the agreements with relation to the shareholders, that is 5A, that needs disclosure only when it is coming to the listed entity. So, for example, if two shareholders of a entity get into picture, get into a transaction, and they don't disclose it to the stock to the listed entity, then there is no responsibility of the listed entity to report to the stock exchange unless it receives such information. If it is a party to that information, or if it has that information that meets this requirement, then definitely the listed entity would go forward and report it to the stock exchange. So I think I covered this, but I'll again. So if there is a default, so for example, yeah, in case of cash credit, how would a default be? For example, if a company has a cash credit limit of say 5 crores, and it has, so there's no breach that is going to happen because there's no repayment per se. But ideally, I would say that you have to look at a longer term, for example, say 15 continuous days, up to which that limit has been breached. And once that limit is reached, you are typically at non-compliance with those provisions, and that can be termed as a non-repayment or a default in that terms. Uh, I think there are two more questions. Okay. In the amendment, details of senior management and details of specific agreements need to be reported in annual report if company has already approved. Is it if company has already approved its report in its quarter four? So I don't think if the report has already been approved and published and done, there's no further requirement because the LODR amendments are yet to be coming in and this disclosure has already happened. So largely for those category also the requirement under the LODR is FY 22-23 or 23-24. So I don't see any revision of audit reports happening. Plus, for resignation of senior management, the requirement is disclose the resignation letter and reasons of resignation letter need to be disclosed within 7 days or the last working day. Sometimes they are taken back in such a way. So yeah, here where there are specific timelines, those 7 day timeline would prevail. So part A, para A. So part A entirely, whatever timelines are mentioned in part A, that would have a precedence over the general timeline. If there are no timelines mentioned in part A, then the general timelines will take precedence. Great. So I think we have overrun by a few minutes. We started sharp on time, but the content was just too much. I also picked a bit of pace in between. And if there are any unanswered questions or any provisions that you you want to discuss in better depth with us, just feel free to reach out to us. We are available to discuss any of these questions, and we are happy to take them. With this, I think I'll have the closing remarks and thank everyone for their time joining on today. And with this, we'll also end the webinar. I would ensure that each of the participants receive a copy of the presentation that I've made today. It's with the actionable plan and also Excel sheet where I have captured the Schedule 3 amendments. So I'll share that separately with all the participants. And I personally thank everyone for joining in today. And I trust I would have been able to add some value to you. And thank you once again for joining. Good evening and have a good day. Bye.